Welcome again. In this lecture, we will learn how to read options chain. Options chain is a way to code options prices having different strikes in a list. This long list has all the put and call strikes along with their prices and other informations for a given expiry. Options chain have two sections, the left half for call and the right half for put options. In the center, a list of strike prices of option contract is displayed. This is the options chain of Nifty 50 and the expiration date is 26th of July. We can change the expiration date. We can select the August expiry and the September expiry, but the current month is July, so we will select the July expiry. So these are the calls and these are the put options. These are the various strike prices. As you can see, currently Nifty is trading at 10,960. So 11,000 is the nearest option to 10,960. So it is assumed as at the money option, and the yellow strikes are the in the money option and the white region shows the out of the money options. These are the put options. So yellow portion shows the strikes that are the in the money put options and the white portion is showing the strikes that are out of the money put options. LTP shows the last traded price. All the options are not traded every day. So the price at which it was traded last is listed here. For example, these options are not traded today, so there is no LTP, and for put options, these put options are not traded today. This column is the net change and this is the difference between the closing price of the security and the previous day's closing price. It can be negative or positive. See here, for put options, this net change is negative and here the net change is green and this is positive. It means today change in Nifty is 0.46%, so the put options are active and these put options are in profit, and the column shows the net change in the strike. For example, the net change in 10,900 put strike is 8.20 and this is positive. It means the price of 10,900 put option has increased by 8.20 today. These two columns shows the ask price and bid price. Ask price is the offering price at which the option contract are made available for purchase. It means if we want to buy and call option, we will see ask price, and if we want to sell call option, we will see bid price. Similarly, if we want to buy put option, we will see the ask price of put option in the right side, and if we want to sell a put option, we will see the bid price. Bid quantity is the total quantity of current number of buy orders in the system, and the ask quantity is the current number of sell order quantity. Volume is the total number of contracts traded on the present day. It is always positive and starts from 0 at the start of the day and increments as when new trades occur. A good volume means good liquidity in the market. Open interest lists the number of open positions for a particular strike price that are live in the market. Volume and open interest are two different things, but have similar set of information. Volume data always increases on an intraday basis, but open interest is not discrete like volume. Open interest increases or decreases based on entry and exit of trades. Open interest also gives us idea about the support and resistance level. For example, we can see that 11,000 call option have the greatest open interest for this expiry and the 10,600 put option is having the greatest open interest. Put options gives us an idea about the support level and call option gives us an idea about the resistance level. As we know, when a support level is penetrated below, it becomes a new resistance level, and when a resistance level is penetrated, it becomes a new support level. So we should always see the second highest open interest in the strikes, and if we see the second highest open interest in the put option, this 10,800 put option is having the second highest open interest and 11,100 call option is having the second highest open interest. So we can expect a range between 11,100 and 10,800 for this expiry. We can also see that 10,600 put options open interest is decreased today, but 10,800 put option open interest is increased today. And we can also see that the open interest for the call option, these two call options, has increased today. So if Nifty reaches 10,800 level, we should buy the call options for Nifty. The last column is of implied volatility column, and we will discuss about implied volatility later in this course, but now see here that the implied volatility increases for the out of the money options. This white portion options are the out of the money call options, and implied volatility increases for the out of the money call options and also for out of the money put options. When implied volatility increases, it means premium is also increasing. So we should always sell out of the money options, and we should not sell in the money and at the money option strikes, because the implied volatility for those options is very low. So the implied volatility for these out of the money call options is very high, and the chances for these call options to be in the money are very low. We can sell these call options. And also implied volatility for these put options are very high, so we can sell these put options. So in this way we can read the options chain of any stock or an index, and this is very helpful for us if we trade in options.